Welcome to this background lecture in the practical pricing in Python course or learning community as it's called in University of Groningen. So what I'm going to talk about today is give you basically some background on options. So this learning community is basically about pricing options. So to compute to code actually, to write a code in Python to compute the value of an option. And you can actually do a lot of that without understanding too much about what a financial option actually is. But so this lecture, this video actually, is going to help you to understand what we're actually doing and how that relates to actual options, actual financial options. So what I'll do is first outline, we'll give you an introduction of what options are, and then we'll go into the some properties of those generic properties of those options. Then, in order to delve a little bit into the theory, not too much actually, but a little bit into the theory of how to price options, I have to say a bit about stochastic processes, which is going to describe basically the behavior of the evolutions, basically the random paths that stock prices follow in the future. The description of those paths. And then we'll have a look at the stock price process, in particular at the Black-Scholes value of option pricing. So it's a celebrated solution that goes back to the 1970s already. And in the end, I'll outline very briefly for you different ways there are to actually price options in practice. So we'll have a look at that in the end. So just as a background introduction, so what is an option, a financial option? So in order to explain that, actually, it's good to actually start with explaining what a forward contract is, which is related to it, but it's slightly different. So a forward contract is a contract that you and I, for instance, could conclude, could write, which would say that at some point in the future, say 1 month from now, I might be able to buy from you, I will be able to buy from you some asset that you own. So this asset is going to be called the underlying, because it's the asset that's going to underlie this contract. So in our case, it will be the stock price. So the forward contract will tell us 1 month from now, at time t, that's 1 month from now, and that's also called the maturity of this contract. I will have the right to buy from you a particular stock, say the stock for Royal Dutch Oil, so Shell Oil, at a certain price. And this is going to be an obligation. So, for instance, it says, 1 month from now, I will have the right to buy one such stock from you at a price of 20 euros. And this right is actually going to be an obligation. So basically I have to use this right. So I have to buy at this 20 euros this stock from you. And that's going to be a good deal for me. It's going to turn out to be a good deal for me if at that point in time this Shell Oil stock price is going to be worth more than 20 euros. Then I can buy this stock, which is worth more than 20 euros, say 23 euros, for instance. I can buy it at 20 euros and I'm going to make a profit of 3 euros. But if at that point in time this same stock is worth less than 20 euros, I'm also going to have to buy it from you, and then basically it's going to be a loss for me and a gain for you. So this forward contract is essentially an obligation to do this trade at this maturity time. And this trade is going to occur both in good times and in bad times for me. So now that's a forward contract. So as an option contract, well, an option contract actually provides me with the choice whether I want to use that right. So this option would say, well, I can buy this share from you at this particular price. So it's price, let's call this K. So it would be the 20 euros that we just talked about. So I have the right to buy this stock from you 1 month from now at time t, capital T, the maturity. But I don't have to. I don't have an obligation to do so. So, well, when will I do so? Well, only, of course, if this stock is worth more than this 20 euros at this point in time. So, because then I will make a profit. But if at that point this stock is just worth, let's say, 17 euros, then I'll just throw this contract in the bin. I will not use it, and I make a zero payoff at that point in time. So I will only use this right, or exercise this right as it's called, whenever it has a positive value at that point, and if it has a negative value, I will not use it. It also means that this contract for me will always have a positive value. It cannot be worth a negative amount for me because I can always choose not to use it, giving me zero as a payoff. Whereas there's always this chance perhaps that this Shell oil price will actually hit some value at that point in time above this exercise price K. So here's a picture of that actually. So this option that I just described was called a call option. So the call option for me is basically the right to buy the stock from you. So here this graph actually gives a depiction both of this forward contract and also of this call option contract. So the black line essentially is the forward contract, and it extends actually all the way to the right under this green line. So this whole diagonal straight line is the payoff of the forward contract. And you can see here the exercise price, so the price at which I can buy this particular stock, is fixed at 60 euros. So if at that point in time in the future, 1 month from now, the stock is worth 65 euros and I can buy it from you for only 60 euros, well, of course, then I'm going to make a profit of 5 euros, would be this point over here. On the other hand, if at that point the stock price is worth only 55 euros, then I'm going to make a loss. And then this forward contract for me is worth -5. So I'm going to make a loss of 5 euros essentially on this contract. So the green line with this kink in it is called the payoff of the call option. So call option, remember, I can always choose not to use it. So whenever it has a positive value, which happens if the share price happens to be above the exercise price, I will use it. So I will have this positive payoff here. So again, if the stock is worth 65 euros, I'm going to make this 5 euros a profit at that point in time. But if this stock is worth less than the 60 euros, then I'm not going to use this call option. Rather, I'm going to let it expire without using it. So making zero payoff at that point in time. So this is a call option. A call option is the right for me, but not the obligation to buy this stock, this share from you. The converse of that is a put option. Put option is a right to sell. So again, here I have a forward contract, and if I have a forward contract with you in which I'm going to promise to sell a stock at a particular price, that's going to be called a short forward contract, and the opposite would have been a long forward contract. That's what we have been looking at before. So if I have a short forward contract, so I have the obligation essentially to sell to you this stock in 1 month's time, or at the maturity date in general, at this particular strike price, which again I've chosen here at 60. Well, if at that point in time the stock is actually worth less, then I'm going to make a profit because I can sell something to you, this stock which is worth 55, but you're going to pay 60 euros for it. So that's good for me. I'm going to make this 5 euros profits. But if this stock is worth more than 60 euros, I'm going to make a loss. So that's what the short forward contract would do. A put option again gives me the right to sell to you. So I'm going to use that right only if it's going to be valuable for me to use it. So whenever this stock is worth less than 60 euros, I'm going to be very willing to sell this stock to you for this price of 60 euros, making a profit. Well, again, if this stock is worth 55, I make this 5 euros profit. But if actually the stock is worth more than 60 euros, I'm not going to use this put option contract, but rather I either might hold on to this stock or I might sell it in the market. So getting the market price for it, getting no excess profits from that. So that will give me a payoff essentially of zero from the put option contract itself. So those are the call option and the put option. So just to summarize basically some of the terminology that we have, most of which we have already seen, so which I just discussed essentially. So the underlying of an option, a call option or put option, would be this asset, so in our case this stock, on which the derivative, which is this contract, the forward contract or the option contract, is based. So in the example, the asset was a stock price, but it might be anything. So another common kind of option would be on interest rates or on bonds. So essentially any assets that might be traded could be the underlying for some derivative contract. So then this number K, so this amount that we agreed upon for selling or buying this stock for, was called the exercise price, or is also called the strike price in option language. So in this graph, our K, our strike price or our exercise price, was 60 euros. And indeed, when we are going to use the right to buy or to sell, so the right to buy if it's a call option, or the right to sell if it was a put option, and we call this exercising the option. And if I don't use it, then this option is going to expire worthless. So if I sell the option to you rather than buy it, I give you the right, and that action of selling an option rather than buying an option is called writing an option. So if I write an option, I'm going to sell the option to you so that you have the right to either buy the product, the asset from me, if it was a call option, or to sell that asset to me if it was a put option. And in return, you're actually going to pay me some money, which is going to be the value of that option upfront. So you give the counterparty, you in this case, I would give you the right to buy or sell from me. So if this option actually has at the current, if I would exercise it today, if the stock price is above the exercise price, I would like to use it, and then we call this option in the money. If vice versa, this stock price is below the exercise price below K, then we call it out of the money, and I will actually not go and use this particular option. So this as smaller than K, well, that is called out of the money for a call option. Of course, if it's a put option, that would be precisely vice versa. So, or the last terminology here is if an option, or if the stock price is worth exactly the same as the exercise price. So this knife edge case, essentially, that's called at the money. So finally, these graphs that I showed depicted for you the payoffs of the option. So the money that I get when I exercise this option. At the moment when you write this contract, and I'm going to sell to you the option, or when you're going to sell to me this option, then the buyer of this option is going to pay the current value of this option. So this option itself will have a price, which might be even positive even if this option is out of the money. So if it would be valueless if exercised today, because in the future this option might actually turn into the money so that it would have a value at that point in time. So that's some terminology that is useful to know when talking about options. So these call options, put options are basically the plain vanilla flavors of options. What I didn't mention so far is that they can be, in the example that I gave, essentially they were European style options, and European style means you can only use this option, so you can only exercise this option at the maturity date. So at this date T. So in our example, that was 1 month from now. If in contrast, we have an American style option, well, then this option gives you the right not only to exercise it at that time T, so at this maturity date 1 month from now, but actually at any time up to and including T. So if I like to actually use that option today, I'm allowed to do so if it's an American style option, I have to wait until the end date, until the maturity date, if it's a European style option. So those are, this is one dimension in which you can change an option contract. Of course, other dimensions in which you can change option contracts is in terms of this payoffs. So I just now explain the call option, the put option, the plain vanilla options, which basically tell you to give you the right to buy one option at the price that it's written in the contract. Some non-standard payoffs for option contracts will give rise to exotic options. So some examples here would be, well, Bermudan option. So a Bermudan option essentially is an option which says, well, you have it's basically in between the European and the American option. It says, well, you have the right to, of course, exercise this option at the maturity date. And you have also the right to exercise this option before the maturity date, but not at just any day. Perhaps there's only at the first days of the week or the first days of the month that you're allowed to exercise the option, and then the rest of the days of that week you don't have that right. So at some points in time you are allowed to use the option before maturity. At some other points you are not allowed. So this right actually is sort of switching on and off through time. An Asian option would be an option on the average of the stock price rather than the stock price at the maturity date. So an Asian option would say, well, at the maturity date, you have the right to buy the stock at that moment. What you're going to pay is the average price of that stock during the whole duration of that option. So that's a bit different. That's another example of some exotic option. A barrier option is an option which actually only either comes into being when this stock price during the lifetime of the option crosses some particular barrier. So perhaps we have a call option on this Shell oil share, but it only comes into being if during this lifetime Shell oil actually crosses some either upper or lower bound in its path. So only if first the stock price crosses a barrier of 15 euros, only then this call option will, so it first goes down from its current price, 17 euros, down to 15 euros. Only at that point actually the option starts to exist. The option to buy perhaps at the later point in time for the strike price that we have concluded. So that would be a knock-in option. So it only starts to exist when the stock price passes this particular threshold. And the converse of that would be a knockout option, which actually means that if the stock price is before the end date of this option crosses the barrier, crosses this threshold, actually it's going to vanish. It's not going to be valid anymore, and then it will be called a knockout option. A look-back option is an option which refers to some previous value, basically like this Asian option, which refers to the average price of the stock during the lifetime of the option. A look-back will actually refer to, for instance, the minimum or the maximum of this stock. So perhaps you, when you would like to buy an option, or when you want to buy a stock, you might at some point say, well, I regret that I didn't buy it at some earlier time when the stock was still worth a bit less than this. In particular, I would have loved to buy this stock at its minimum value. Well, if that's you, well, then you would like to have a look-back option, because you can then buy actually a look-back option, which says, well, you're allowed to buy at the maturity date this particular stock at for instance, the lowest price, the minimum price that this stock has reached during the lifetime of this option. That's of course very nice to have, but of course you're going to pay for that right upfront. A basket option is one other example. A basket option would be an option on a number of different assets. So for instance, a number of different stocks. So for instance, it might be an option to buy the stock in a particular basket which has appreciated the most during the lifetime of the option. So you might have 2 or 3 stocks in this basket, and you, at the end point, you look at which of these has appreciated the most during the lifetime of the option, and well, that's the one you're allowed to buy at the particular strike price. So those are just examples of exotic options, but basically you can go wherever you want. So you could, and if you would like to, if you work at an investment bank, you might need to create any payoff that you or your client in that case desires. So that would be a bespoke product, of course. Depends on what your desires, what your preferences are. So these options are not traded actively on exchanges, but you can write any contract that you like. So any payoff that you like, and you would like to be able to actually compute a price that's going to be a fair price for that option, and actually also a price which would allow you, if you're selling that option, to hedge this product in the market to make sure that you don't bear too high a risk during the lifetime of this option, and perhaps also which will also allow you to make a little bit of money from it as well. So that was basically the first part, background to some terminology basically of options. So in the next part, we'll have a look at some properties of options.